the fascinating world of gold prices and their potential impact on the US dollar. Gold has always been a significant player in the global economy, but recent trends have sparked some intriguing questions. Is the surge in gold prices killing the US dollar? Let's break it down. First off, let's talk about India. Gold is a massive part of Indian culture and economy. Just like the American dream is to own a home, in India, the dream is to own gold. That's more gold than the central banks of the US, Germany, Italy, France, and Russia combined. For perspective, the US holds around 8,100 tons of gold, while Russia holds 2,332 tons. But Indian consumers alone hold a staggering 21,000 tons of gold. Now, in the past 6 months, if you've been watching the markets, you might have noticed something wild happening. The Indian stock market hit $5 trillion, overtaking Hong Kong. At the same time, gold prices in India reached an all-time high, soaring above 70,000 rupees. While the Sensex returned 8.33% and the Nifty 50 nearly doubled with a 99.92% return, gold prices shot up by an astonishing 16.16%. So why is this happening? One key reason is that central banks around the world are on a gold buying spree. Over the past 2 years, they've been stacking up tons of gold. For instance, India recently moved 100 tons of gold back from England. In recent years, India bought 69 tons, China bought a whopping 314 tons, Poland purchased 130 tons, Singapore grabbed 125 tons, and even the Czech Republic added 75 tons to their reserves. This global trend of gold hoarding has driven prices to unbelievable levels. So, why are central banks loading up on gold? What are the global factors at play, and should you consider investing in gold too? Back in the early 20th century, the world had already endured World War I, and by the late 1930s, World War II was in full swing. The infamous Treaty of Versailles, signed after World War I, set the stage for economic turmoil, which eventually contributed to the outbreak of World War II in 1939. The entire world united against Hitler and his regime, leading to the most devastating conflict in human history. At this time, the British Empire was a global superpower with vast colonies spread across the world. However, the economic toll of World War I and World War II had significantly weakened Britain's wealth. By the early 1940s, Britain's debt to GDP ratio had skyrocketed from 25% in 1914 to 220% in 1920, and further to 270% by 1942. Similar economic distress was seen in other major countries like France and the Soviet Union. Meanwhile, the United States played its cards wisely. Initially, the US stayed out of direct involvement in these wars, acting instead as a supplier of essential goods. America, untouched by the war's destruction, became a prosperous land of plenty. Cheap fuel and technological advancements powered a booming economy. American industry was perfectly positioned to dominate both domestic and global markets after the war. Here's where it gets interesting. While other empires were fully engaged in the war, diverting all their resources to the battlefield, the United States focused its capital and manpower on becoming a major supplier. They provided cotton, wheat, brass, rubber, automobiles, machinery, and thousands of other goods to the war-torn countries. This strategy led to one of the greatest economic booms in US history. US exports skyrocketed from $2.4 billion in 1913 to $6.2 billion in 1917. In the 1940s, the world had already experienced the devastation of World War I and was in the midst of World War II. The infamous Treaty of Versailles, which ended WW1, had set the stage for economic turmoil, eventually contributing to the outbreak of WW2 in 1939. By profiting from these costly wars, the US accumulated vast wealth. While other economies lay in ruins, the United States ended up holding 75% of the world's monetary gold. US gold reserves surged from around 2,000 tonnes in 1910 to nearly 20,000 tonnes by 1940. This unprecedented wealth set the stage for the United States to solidify its economic dominance. In 1944, the US convened a conference in Bretton Woods, New Hampshire, gathering representatives from 44 allied nations. The goal was to establish a new international financial order and promote economic cooperation post-war. This meeting resulted in the Bretton Woods Agreement. Under the Bretton Woods Agreement, these 44 countries agreed to peg their currencies to the US dollar, which was in turn pegged to gold. This arrangement meant that 1 ounce of gold was worth $35, or 28.35 grams of gold equaled $35. The US promised to redeem dollars for gold, effectively backing the dollar with gold. This gave countries confidence in holding US dollars, knowing they could exchange them for gold. So, why did these countries agree to the Bretton Woods Agreement? The main benefit was stability. By pegging their currencies to the US dollar, countries gained a reliable exchange rate system, which facilitated international trade and investment. Additionally, backing the dollar with gold provided a sense of security, as gold was universally recognized as a valuable and stable asset. This system helped the US dollar become the dominant global currency, underpinning international financial stability for decades. The Bretton Woods Agreement laid the foundation for the modern global economy, with the US at its center. The Saudis were not wealthy in the early 1940s because their oil production was just beginning. During World War II, Italy bombed Saudi Arabia, targeting American oil facilities, which hampered the Saudis' ability to produce oil at full capacity. In desperate need of protection, Saudi Arabia sought help from the United States. In 1945, US President Franklin Roosevelt recognized the immense global importance of oil for the coming decades. He held a crucial meeting with the King of Saudi Arabia, resulting in a pivotal deal. The United States agreed to protect Saudi Arabia from future attacks and supply them with military equipment. In return, the Saudi king agreed to sell oil primarily in US dollars. This deal significantly boosted the rise of the Middle East and cemented the US dollar's role as the dominant global currency. By the 1960s, when oil-producing countries formed OPEC, all member nations started selling oil in dollars. However, recent geopolitical events and economic practices have led to a gradual decline in confidence in the US dollar. During the Russia-Ukraine war, the US froze $300 billion of Russian assets and $7 billion of Afghan assets after the Taliban took over. This move alarmed countries like China, which feared similar actions against their $797 billion in US Treasury bonds. As a result, China and other countries started buying large amounts of gold as a hedge against the potential devaluation of their dollar reserves. The US's frequent money printing has also contributed to the declining confidence in the dollar. For example, the US printed nearly $1 trillion during the 2008 recession, $4 trillion in 2020, and about $2 trillion in 2021. This excessive money printing leads to global inflation and reduces the value of the US dollar. Consequently, countries with significant dollar reserves, like China, see their reserves value diminish. Gold, being a finite and non-printable resource, retains its value, making it an attractive option for countries looking to preserve their wealth. The limited availability of gold, enough to fit in a 23-meter cube, ensures its value remains stable. Thanks for watching. Please like the video, press the subscribe button, and also drop your thoughts in the comment section.